Ready, we're live. Apologies for the 3-minute delay. Let's get into it. I'm an associated member of T3 Trading Group, which is an SEC registered broker-dealer and member of FINRECIPIC. All trades placed by me are placed through T3 Trading Group, and you should carefully consider whether trading is suitable for you in light of your own financial condition. I gotta take this one position out. I'm not actually in. Give me a second here. I do not have a position. Oh wait, no, I do have a position in that. I do not have a position in this. Just want to make sure that everything is all hunky-dory here with the compliance department. So that is my accurate position disclosure. And on that note, let's look at the charts. Okay, so quite a little snapback here if you're looking at this daily candle. It's a pretty candle. You know, we got a nice little tail here below 420, and we closed back within Friday's range. So you technically do have like a red dog reversal type of situation. And based off of this candle, we could be looking for an oversold bounce too, as much as the ADMA over time. The ADMA is currently trading at above 435, but we got to keep in mind that the ADMA will continue to go lower as price is below. So this is going to catch up on the downside, and we'll see if we can get further follow through to the upside from the market to satisfy our oversold conditions. And we were certainly oversold today. What about the Qs? Qs were our leader. Qs are up 1.2% today, whereas the S&P was only up about 0.5%. Qs also, you know, nice snapback from extended territory here off lows. We're not quite at that ADMA, so let's see if this high volume candle here can lead to further follow through. A lot of the potential follow through in this market is going to be caveated by the earnings season that we're in. So I think we have Alphabet after the close tomorrow. We have Facebook, or Meta, I guess they call it now, after the close on Wednesday, and Amazon and Apple on Thursday. It's always crazy to me that they do Amazon and Apple on the same day, right? Can you give us a break? Can we at least spread them out a little bit? But we'll see. And then the IWM here, similar situation. Did we get a yearly closing low in the IWM? We did not, but we were trading at one point today where it looked like maybe we were. Oh, we have Microsoft tomorrow too. Wow. We were trading at one point today where it was looking like we could see a new yearly low on the Russell, but it also was able to give an oversold bounce back. So this morning, just to kind of recap the morning meeting, we identified the market as being really oversold here. And there was also some cool statistics from Pat's note that we can take a look at and review again in a second also. With that said, there was the potential of seeing further downside momentum, because the way that I like to look at market extension is where the market is trading versus the space between the 8 and 21 EMA. The space between the 8 and 21 EMA is my blue and red lines here. That's the space that I consider to be the technical equilibrium for the market. So when you have a weak market, the ADMA is going to be below the 21 EMA, so I would consider the ADMA to be the lower band of equilibrium. So if we can just touch this ADMA, we would no longer be extended. So we were extended today based on a lot of metrics. You know, you got your ADMA at, let's just call it 436, and the market trading at 420 or even below that at one point today. So, you know, you're $16 extended to the downside. But one thing I did want to note is that momentum can be a heck of a thing, right? We know that a market that is exhibiting signs of momentum is a market that can go from being already oversold to significantly more oversold, or already overbought to being significantly more overbought. So there certainly was the potential of seeing downside momentum today, further momentum that would get us even more extended. You know, 420 is kind of a big level. It's really the space here between like 415 and 420 at this point on a closing basis. But 420, 430, 440, 450, and then not 460, I guess a little bit above it, has kind of been key levels here for the market. It's not always every 10 bucks like that, but in this circumstance, it's kind of been kind of clean on what the levels were. So there was certainly the potential when we broke below 420 today that we could see momentum come in that could bring us down and could make us even more extended. For reference, 2 of the 3 big bounces that we've seen this year, one was here on January 24th, one was here on February 24th, and one was the low that we had discussed from March 14th into March 15th. Those are our 3 really big bounces. And 2 of those 3 occurred on degrees of extension at these lows that were even significantly more than where we were. But I would argue that these lows here that we saw, these extension bounces that we saw on January 24th and February 24th, were like extreme. I don't really recall almost ever in my trading career seeing the market get as extended as they did get. Oh boy, I don't like that headline, Pat. Russia Foreign Minister Lavrov, the danger of nuclear war is serious. It is real. It should not be underestimated. But Russia's strong position is that nuclear war is unacceptable. Okay. All right, let's keep it unacceptable. Anyway, sorry, that headline caught me out of the corner of my eye. Back here, this day we were so extremely oversold. The low is about 421 with the ADMA at 451. So we're $30 extended here from the ADMA. And about, on a percentage basis, right, we're trading around the same area, so we can look at it on a dollar basis. Here, at 419, let's just say, versus 436, let's call it, we're extended by $18. So we're almost double at this low the amount of extension that we were at lows today from the way in which I like to view markets. And here also, this low on February 24th, not quite as extended as the low from January 24th, but more extended on the way that I look at it versus today's low. So without a doubt, there was a chance that we could get further momentum to the downside, but 2 really big down days in a row leading to a gap down this morning is going to tend to be a recipe for a bounce, and we're coupling that with other information. To go back to Pat's note here on some of the charts that got posted that we brought up in the morning meeting today, you've got Goldman's positioning indicator here, which is at lows going back to January 21 here, extremely light positioning. We coupled that with information that we saw on Friday that was from Interactive Brokers, which is a little bit more on the retail space. I basically said that Interactive Brokers clients are sitting more in cash and more short than any time since, I don't remember the exact statistics, but it was like a very notable piece of information there. And then our short-term tactical sentiment indicator, which again, the way that I like to use this is not that we can't go down when this is in the green. It's not come in and just automatically press your buy button. It's just an extra layer of probability that we could be looking for a bounce. And generally when this is in the green, it means that I don't want to be shorted. It doesn't mean that I want to buy. It just means that I don't have a great risk reward on the short. So if you are looking for a short, and Mike, if you're listening, because I know you had those questions earlier, if you are looking for a short, when you've got all of these pieces of information in place that are going to say that, it's not a great risk reward and probability of success too short, you can still make money to the short side, but it really needs to be based on pure momentum. That's the only way that an extended market can become more extended is through pure momentum. So, and this is as the Friday's closed, and then we gap down. So this thing is probably also like I don't know how far back this goes, but it's also kind of at a record. So we have a lot of pieces of information, and by the way, the best opportunities this entire year from the market perspective have always come in these periods of market extremes. And that's what made the last 2 weeks of trading when we were stuck in this tighter range here so difficult. I've heard a lot of people complain that 2022 has been a very difficult year. I don't really fully agree on that. I actually think that there's been a lot of opportunity in 2022, but you've had to be really patient and really pick your spots. And if you pick your spots and you focus on the right day and you're aggressive on the right day, there's actually been a tremendous amount of money to be made. I mean, as a team, we caught every one of these lows. We caught this low in January. We caught this low. I mean, this low in February was so easy. We were super aggressive to the long side right off the open that day because we understood exactly what was going on. This is the day that Russia invaded Ukraine, and we just looked at our statistics. They sold the market off into it, gapped it down massive on it, and we recognized, hey, you know what? Historically, maybe nuclear war here is going to be a different situation if that actually happens. And in which case, if that happens, then none of your money or markets or charts matter. But historically, wars, we've looked at all the data, the statistics, it's usually not bad for market outside of a brief blip lower. And we really came in, we were able to take advantage of this low. Then back in here, we were noting similar data to what we noted here. I remember likening into these trading sessions. I think this was a Monday. I remember on this Monday afternoon meeting, and then we gapped up and went, describing the market like a coil that had gotten just, too tight, right? Because everyone was short. There was massive data on the shorts that were out there. No one was invested to the long side. Seasonality into the end of March is strong. You had the rotation that would be coming from like the sovereign wealth fund of Norway and stuff like that would lead to more potential buying in the SPYs. So by paying attention to the data and being patient and positioning yourself, this year has been full of tremendous opportunity because these moves have been so big. And then it was the flip side here. This is where, we were talking about hedging ourselves. I was shorting the TQQQ, I was shorting the S&P, I was shorting the Qs, really hedging out and selling a lot of the longs I had on the way up, really hedging myself. So I really think that this year has had a lot of opportunity. It's just different. It's not the same market environment that you had when these stocks were going crazy at the end of 2020 into 2021, and we're getting, there were bubbles everywhere, and you could just close your eyes and, press the buy button and make money on any stock that you looked at. It's been a different environment than that, and you have to adjust to it. But if you pay attention, these market extremes have been amazing. The issue with the last couple of weeks is that there was that huge volatility that created these huge movements in market extremes all of a sudden just stopped here for most of April. It just stopped. We got into this really tight range. Is the support going to hold? It looks like it's going to break down. Then we'd have a bounce. Oh, is the resistance here of this consolidation going to break? Oh, it looks like we're breaking out. And then bam, we're all the way back down. And then finally we had real resolution for the first time between Thursday and Friday to the downside, which, believe me, I know that, maybe if you were really looking long here and you got faked out on this breakout higher off Tesla earnings on Wednesday and Thursday, that maybe this was a little bit painful for you, this pullback over the last couple of days. But big picture as traders, this is better. This is definitely better. This is going to lead to more opportunity if we can get these bigger movements. Let's assume that the market doesn't want to just pick a direction and stick with it. But if we stay with this theme of honestly broadly sideways price action but with a ton of volatility, these extreme points of price action really breed opportunity for us. But this tighter action in here that we got, where it was just like, I was so frustrated here the last couple of weeks because it's like, all right, market's going down, and then the next day, for no reason, the market's is acting strong, and the next day, for no reason, we're fully retracing that, and then 2 days later, we're fully retracing that back to the upside. There was like no rhyme or reason to the price action in here. So the message of the market, honestly, was just to go hands off and to be able to take a half step back. And now finally, we can start to read this data, and we can look for information here, and we can pay attention to paying attention to UVIXI today was a really big catalyst, right? Once we lost the 16 that we were memeing about, like in the VTF today, we lost the 16 and we rolled over. That was the market that it was a signal that the market could eventually work its way back up. And the other one that kind of helped me call it the low today was going back to this idea of understanding this big picture of where we are with the market, that the way that we should be going lower is really through momentum. So, going sideways here for the first half of the day, without a doubt bearish. Because what does this sideways price action do? Where's Pat's? No. That sideways price action means that we don't have to bounce for this to get out of that green zone. This can come right back into the light zone just by sideways price action. Or the way that I like to look at technicals is if we're going sideways here, that's letting these moving averages catch up. So we're becoming less extended. So the sideways action without a doubt is bearish, but we were so extended here that I guess even a half a day wasn't enough. Because as we broke to new lows, as we broke that key 420 that the market was really trying to hold here all morning, this should have been a momentum downside move. If we were really going to go lower, this was the bears' opportunity. They needed to bring in momentum here. They needed to resume that god-awful looking trend here that we saw over the course of Thursday and Friday. We gap down, we digest for a while here. This trend line, whatever, is starting to catch up. This is where the momentum needs to come in. And I looked at the SPYs here and was chatting with you guys through the chat, and even before we got back above 420, I was like, this market's just not breaking down the way that it should. And if we can get back above 420, that actually might be a real signal here that we can go higher, because we should be breaking down in a major momentum type way. And as you guys have all heard me say in the past, a lot of times when things that should happen don't, it's a signal that the opposite's actually going to happen. And that's pretty much exactly what happened here. So I think, at 11:55 on this bar, which, by the way, is not the time of day that I'm usually looking to trade actively. That's when I called out, like, oh, I'm looking to buy some Apple. Oh, this is when I bought this tallow in here, because I was looking at the XLE at that time, and the XLE was increasing volume a little bit and looking like it was looking to hammer. And this is what I'm always talking to you guys about, that you need to do. The market's very dynamic. So you can't ever, and this is what's so hard about trading, especially if you're newer, is you can't ever just look at one thing and make a decision off of it. It's all of these pieces of information getting put together. It's understanding the degree of downside extension. It's understanding market positioning. It's understanding market sentiment. It's understanding market technicals. Putting all of that together and saying, hey, how come we're not breaking down the way that we should? Oh, look at this, some little volume increase in the XLE. Not normally the type of day here that I like to trade, but look at this little hammer coming in. Maybe there's something to this. Maybe I have and for me, tallow is already a position that I've been in, that I've been trading really actively. This is a great time. I had mentioned that I had sold out almost all of my tallow by the time it got back above 20. And initially I was looking to rebuy into the ADMA, but not on this candle. This closed terribly. Not on this candle. And now, okay, here, this time of day, maybe I'm getting my signal that I can finally come in and kind of repurchase this. And I can kind of buy, we kept talking about, for Apple, this was on our list today, the 200-day. Can this 200-day really hold? It doesn't matter, by the way, if it just trades below it for a little bit. The slope of the moving average is what's key. But we're extended into the 200-day. I don't believe that moving averages are support and resistance. I talk about that all the time. But it doesn't make it important. It doesn't mean that eyeballs aren't on it, and it doesn't mean that it can't be somewhat of a self-fulfilling prophecy. So pre-market, we're kind of holding that 159 area. That's what I was saying we needed to hold. And then Steve from Denver asked me, because I didn't get filled here. I was looking to buy like right in front of 159, and I just kept kind of not getting filled. And then Steve from Denver asked me, he's like, Derrick, you still going to buy that 159? And that's when this thing was going up. And I was like, I probably shouldn't do that. I probably don't want to be buying the 7th time it's testing after now it's trying to rally back above 160 if I never got filled at 159. I had already bought some Apple pre-market around 160, maybe a little bit below 160, that I was still sitting on that position, but I was looking for an ad, like a real tight ad, kind of off that 200-day area, but didn't get filled. You almost don't want the stock now, but now I'm looking at the market, again, looking at the market, SPYs maybe trying to get back above that 420, and at the same time here, Apple, maybe I don't want to be buying in front of 159 now, because I never got filled these other times, but what do I always say? Buy on the way up. Right? Don't just pick bottoms, buy on the way up. So I can buy this back through this 159, call this stuff out to you guys. And then, Apple, which kind of had been a laggard today as far as big tech goes, eventually gives a decent snapback to 163, turns into an okay trade. It's been one of the best stocks that's out there. Obviously has earnings on Thursday, so limited time on this trade to see what kind of profit cushion I can get. But also turned into being a pretty good trade. And that's on top of another thing that we did great today. Another thing that we've been doing great all year as a team is identifying relative strength and relative weakness. We did a fantastic job, again, shout out to Stefan and a couple other people here in the team, recognizing relative strength, come into value, recognizing relative strength, come into energy earlier in the year and making that a focus. And I have found it interesting that on Friday, it was very notable, and we talked about it during the day, that the market got destroyed on Friday. Every single sector was red on Thursday and Friday, which, by the way, is almost something we almost haven't seen all year. Almost every day, even on the bad days, it seems like there's money getting rotated into at least somewhere. I'd be curious to know the data, because I'm just kind of going off my brain here. I'd be curious to know the data on how many days we have actually had this year where we are in a bear market for the NASDAQ and the IWM and a correction for the S&P. I'd be curious to know how many days this year we have had it where every single sector actually closed in the red. I would imagine that compared to the amount of big red days that we've had here in the SPYs, that it's not a large number. Because it always seemed like there was some sector rotation, there was something that was holding up that was able to be green even as the market sold off, and that changed on Thursday and Friday last week, where we had 2 days in a row where every single sector finished in negative territory, which is typically more of a hallmark of a real bear market, where they just sell everything and ask questions later because they need to raise money and they don't want to be in risk assets. But out of nowhere on Friday, and by the way, usually when the market is weak, the weakest of the weak are growth stocks. That's what we've seen all year. Most of the time, if the NASDAQ's down 2%, type up your average growth stock and you're going to be seeing it down 5-6%. Yet, Friday, with the market doing what it was doing, growth held up so well. I remember trading Path, which I've been trading pretty consistently on a lot of these days recently. Seeing Path on Friday, which I think I bought like right at the open on Friday, and I couldn't believe that this thing was trading the way that it was with the market. Look what the Qs. Just look at the Qs. Look what they were doing on Friday off the open. Look at where the third 5-minute bar of the day is on Friday on the Qs versus the third 5-minute bar of the day on Path. It's a totally different story. But like I always say, it doesn't matter how relatively strong your stock or sector is. If the entire market's getting destroyed, it's eventually going to fall through as well. And that, unfortunately, is eventually what happened here with Path. I remember on Friday, a lot of you guys, which I wasn't involved in, were in pins. Which, look at pins making highs on Friday at 10:05 with the market looking like trash. And then, of course, the market eventually got to this as well. I do think that pins was disappointing today. I know some of you guys went back to this one. I didn't get back involved in that one. The one I went back to was this Path. And right away, the second this market opened, similar to Friday, is like, wow, I can't believe how relatively strong like the ARC complex of growth stocks is. It shouldn't be that way. It shouldn't be that way. The market was weak this morning. The market's weak on Friday. These things should be getting pounded into the ground. Maybe it's just a one-day anomaly. That happens. Or maybe we're onto something here by paying attention to one of our key layers of probability, which is relative strength. So it was kind of based on that I did want to come into today with an open mind, with a broad view on who knows what's going to be relatively strong. Maybe it is these energy stocks again. And by the way, though down a lot on the day, this XLE had a heck of a comeback off of its lows also. It's an interesting looking candle here in outer space on high volume. I wanted to come in with an open mind on what could be relatively strong, because that's what I wanted to go after ideally. And once again, it really proved to be risk assets, the most riskiest assets that's out there, which is growth names. So that then led to an additional layer of probability for me for the market that made me think that this market should bounce, even when we had no confirmation here on SPYs. And honestly, I'm still a little bit disappointed. All the SPYs did was get back to like where we were Friday afternoon. It's not like a fantastic bounce here for the SPYs, though it looks like we could be set up for further follow-through. I couldn't help but think to myself, like, how is the market itself really going to continue to deteriorate while they're buying up the riskiest assets that are out there? It just like doesn't make sense to me. So something's got to give. Either it's going to be like Friday, where just eventually these things die once again, or this market's going to have to hold up in one way or another. So super interesting day today, and if you're able to dissect all these pieces of information like we did successfully in the morning meeting, you look at the SPYs and you go, wow, this is a really tricky trading session. But if you dissect and put together properly all these pieces of information, it actually turns into a potentially very opportunistic day. And that's as opposed to these last couple of weeks in here, which have just been so difficult. So I know for myself today, I was able to do extremely well. It's probably my best or my second best P&L in April. So happy about that, just by being able to get involved in some of these positions at the right spot. And I hope you guys were able to do well with it also. Again, I wouldn't necessarily characterize today's trading session as easy, but you very much could have captured these moves just by going off of the information that we were able to discuss in the morning meeting. So I hope that we do get good continued price action. But with all this said, these big earnings reports, Apple being 12% of the NASDAQ or whatever it is on Thursday, plus all these other companies, whatever the total percentage of them is. The picture that I'm looking at here, which looks a little bit, broadly bearish, but a little bit more productive after today's trading session, the picture could get totally rewritten just based on what these earnings reports look like. So we'll see how it plays out. That's all I got for you guys today. I'm happy to answer any questions. I do have to let you know that I have a very hard cutoff to speak with the Chief Revenue Officer at T3 at 5 o'clock today. So I have a maximum of 20 minutes, but I am happy to answer any questions that you guys got. Looking into VTF and I don't see any questions. Anybody have any questions? Or are we doing an early one today? Yeah, so for sure, today is really just it's a snapback from oversold conditions. We are not out of the overall bearish conditions of this market. Market, short time frame here really need to get back above this 435 that we broke from. We really need to negate this negative Maribozu. This negative Maribozu high is at 438.08 for the SPYs. If you negate that, you're getting back into the equilibrium area, and then things are starting to improve. For the moment, all this is an oversold bounce. So let's not get too excited or too overly bullish at this point. For the moment, all we have is an oversold bounce. It certainly has the potential to give follow through to the upside. So if anybody caught anything from good prices today, not a bad idea to look at a short time frame swing here. I'm talking 2, maybe 3 days, and then you reassess as the price action gives you more information if we are able to bounce further and if we get closer to the 80 EMA on the daily. At this moment, all you can expect from this market, best case scenario, is a bounce back to the 80 EMA. But if you're able to get stock at 420 in the SPYs, your bounce back to the 80 EMA is maybe 435. That could be a fantastic risk reward for a short time frame swing trade. From Gabriel, would you short tomorrow if it touches the 80 EMA tomorrow on extension? So great question. Would I short tomorrow if we get great continuation, huge bounce, we're able to be all the way at 435 tomorrow? I would be looking at it. I would want to see a signal. I always want to see a confirmation signal. Like, I look at this area and I go, okay, this is the area where we should pivot down, but now is there a signal on a smaller time frame that maybe we actually should put that on? From Steve here. How do you think Twitter news affected the overall market and will go forward on the near term? I'm not sure. The biggest thing on Twitter affecting the overall market, I think, is what it does to the share price of Tesla. Because Tesla is just such a large percentage of the market at this time. And we kind of discussed that a good bit already through the VTF. I don't think that Twitter in and of itself, getting bought out at 54.20 or whatever, has huge implications overall for the market. Maybe it can have a positive impact on like a Snap or a Pinterest or something like that, maybe they're undervalued and there could be, buyout interest in other social media companies because of how much that they've come down. But that's obviously going to be more one-off. I mean, we did see, I think, some news hit that maybe someone's looking at Match. I think we saw Meta might be looking at Match. So maybe you could just be seeing consolidation of these like more smaller social players that could affect them. Overall, I would not think that it has a big effect on the S&P or the NASDAQ outside of the potential to affect Tesla. which we did discuss today. I personally think that this is a little bit of a dangerous move for Tesla shareholders. I don't know all the numbers yet. I don't know how much of it Elon is having to fund through borrowing on his stock. But it's like I said earlier when we were chatting, and the only reason why this matters is because Tesla is such a large percentage here of the market. But first of all, I'm still curious to know if any of the things that he did that I think are a violation of SEC disclosure rules actually comes back to bite him in the butt or not, or if he once again just totally walks through this without any issues. I think that he should get fined millions of dollars for the way he purchased Twitter, but that's neither here nor there. The real question becomes, as Elon has to borrow, and again, I really want to know numbers here. Right now, this is all kind of conjecture. As Elon borrows money against his stock to be able to fund the purchase of Twitter, how much is that for? And at what Tesla price does it become a problem, right? Because in the event that Tesla were to do a Netflix earning, this one, or God forbid both, or a Facebook earnings report like this one, and the stock is let's just say that Tesla goes to $500. That's a big support area actually. Look at that, 550, huge support area from 2021. Is it that unrealistic in this market environment that we've been involved in for Tesla to, off of a bad earnings report? I know that they just reported earnings and it was pretty good. Is it that out of the box to think that there's a realm where Tesla tests 550 at some point over the course of the next 2 years? If the market goes into, if there's an economic recession and the market stays weak and all the real fears that certain people have discussed were to come to play? No. I want to know at what price is there a margin call against Elon for the borrowing that's on his shares? And what happens in that scenario? Because if Elon was ever forced to sell Tesla, Tesla's going to be in a bear market to begin with, and then you've got forced selling that's coming from Elon. That would be really bad for the stock. And again, there are implications on the broader market just because of the weighting that Tesla now is for the S&P or the NASDAQ. But for the moment, not so much. And once again today, Tesla held support, 975. From Bill here. I recently learned that when shares cost $5 or more, the margin requirement changes. I was wondering if there were other prices where the margins change again. I don't think so. And in your experience, is this something you ever pay attention to? So first of all, it's not something I ever pay attention to because I don't trade on a margin account. I trade on a prop account. So I honestly don't even know too much the ins and outs of margin calls and the different types of calls and different types of requirements and how it works. I did know that on lower priced securities, there were different margin requirements than on higher priced securities. I did not know that $5 was the cutoff. I think that there might be another separate cutoff at below $1, but I'm really not sure. I don't think that there are any other changes on stocks that are more expensive than that. But broadly, I would say this is not my area of knowledge, and it's not something I've ever paid attention to. From Edwin, SPXL for a swing. I like it if you have it from a good price today. I don't like it as much if you're buying it at the close, because you got to look at the risk reward here. If you're buying it at the close at 101.40, you're looking for a move to the 80 MA, which is at, because it's going to come down. Let's just call it 106. So you got, $4.50, $5 worth of upside, but you got to give it down to lows to really trade it properly. Lows here's at $95. So do I want to come in and risk $6.50 for the potential to make $4.50 to $5? The answer is no. This is why, so a couple things here. One, I'm not a huge fan to begin with of buying stock at the close and swinging it, even if that daily candle looks good, because you never know what can happen overnight and you don't have a profit cushion. I want to be in a win-win situation to hold positions overnight. I want to be in the money already on that position so they can keep it overnight, so they can potentially make even more money from the perspective of a win-win. Not just keeping, especially a levered ETF overnight, when who knows what news could happen overnight. The market could easily gap down tomorrow, even though my expectations are that we're going to gap up based on today's close. Pat was repeating the same thing. You never know what can happen overnight. You never know when news hits. There is a real chance that we do gap down tomorrow. What I'm always looking for is that intraday risk for daily chart reward. So if you're buying SPXL, when we were looking at this SPYs getting back above 420, your price on this thing could be 95 bucks, 95 and change. Heck, even if it's $96. Now you're risking $1.50 here versus lows with the potential of this move to the ADMA. Then I love it for a swing overnight. I love it. You're in a win-win situation. You're going to make money in this thing no matter what. It's just a matter of how much. If you're just going to buy it into the close, I don't love the risk reward. I don't love taking on that added overnight risk when you never know what could happen if I'm not in the win-win situation. No problem. From Justin, there could be a day 2 of this RDR type candle, right? Account 419, it was an RDR. Day 2 last week. Yeah, for sure. I mean, so first of all, I don't consider this to be an RDR. Technically, what your Red Dog reversal is I think it's got to be at least day 3. So today is a day 3. So today is. Second here is that all you should really expect, this is where my retracement rules come into play. All you can really expect is a move back to the ADMA, so, which is easily could give a day 2. From BS here, Twitter is set to make about $1 billion. Twitter is set to make about $1 billion, and Elon can use that to make interest payments on his loans. So Elon owns the stock price from $30-something, right? And now he's about to buy the rest of the shares at 54 and change. But how is that putting money in his pocket outside of the stock that he himself owns from 30 or whatever already? Is what I don't fully understand. From their earnings report. Got you. Okay. Yeah, I don't know all the ins and outs of Twitter's fundamentals. I didn't realize that they were as profitable as that, but I totally believe me on it. I do think that Elon needs to come up with a business plan for this buyout that makes the company different than what it's already been. And again, I know it's going to be private, so let's just say in private market terms, what is to stop Twitter from being immediately worth $38 again once the buyout is complete? Was there any new? And they've got earnings later this week. I don't think they've reported this earnings report yet, right? But is there any new? Was there any new business development here outside of Elon himself just purchasing it that ran the stock up that makes it have more value than the $38, $39 a share that it was already trading at previously? Cool. All right. Well, thanks for all the information, guys. I think we will wrap it up here for today. It's almost 5 o'clock. It was a good trading session today. I think we identified the information really solidly. So let's see if we can get follow through tomorrow. Let's see how we gap tomorrow. I think that tomorrow we won't be as extended, so it'll inherently make tomorrow a little bit trickier than today. But once again, we'll assess the information. We'll look for relative strength and relative weaknesses, which has been so key. Really curious to see if these risk assets that have shown relative strength on Friday and today can give follow through to the upside. If the market's able to hold in or the market's able to continue, because it's interesting. They've just been so weak for so long. And that's it. See everybody tomorrow.